Profitability ratios. Are you profitable? Well, I hope you are. We've got the gross margin. Gross margin is sales minus cost of goods sold divided by sales. So really just net income divided by sales. And wouldn't you know it? I mean, it's kind of what we have here as the profit margin. Now, this is all of net income. Keep in mind, this is just sales minus cost of goods sold. So your gross margin is, and this is gross margin ratio, right? Gross margin could also just be sales minus cost of goods sold. So gross margin ratio, profit margin ratio. Gross margin is going to be really just your, again, sales minus cost of goods sold. I'm trying to think of another word, but I mean, that is your gross margin. Like, that's just what sales minus cost of goods sold is. Divided by sales tells you what percentage is your take home, really. Profit margin, net income divided by sales. Net income obviously takes into account all other costs in addition to cost of goods sold. Return on equity. Anytime you see, and I'll make this point a few times, anytime a formula has return on means net income in the numerator. The good general rule, again, return on means net income is in the numerator. And another good general rule, if you have, for example, price to sales ratio, well, something to something, generally price divided by sales, right? Or debt to assets ratio, right? Debt divided by assets. So great way to memorize those. And then we've got this DuPont ROE, return on equity formula. Now, this is just a really broken out formula, and you can see this relates to the net profit margin is this, asset turnover is this, financial leverage, equity multiplier formula is this. Definitely memorize this. This is a formula that can for sure be asked a lot, right? You can be given sales and assets and revenues, and you got to find equity and use a bunch of numbers and come out on top. I've seen it a good amount. Be ready for it. You'll knock it out of the park. Profitability ratios examples. All right. We've been waiting for it. Well, what is given? Spear Corp had sales of $2 million. All right. Well, I'm going to go and read the question. What is the ROE, return on equity? Now, for this, we just needed the normal ROE formula. However, feel free to write out the DuPont ROE. You never know when you might need that. It might be this question. Okay, so net income divided by equity. We have sales of 2 million, profit margin of 11%, and assets of 2.5 million. Spear decided to reduce its debt ratio to 0.4 from 0.5 by selling new common stock and using the proceeds to repay principal on some outstanding debt. Interesting. Okay, so let's think about that in terms of journal entries as well, right? We are reducing the debt ratio by selling new common stock, so we would increase cash there, and then increase common stock, and then we would also then use that cash to pay down debt, thinking about what's going on. So after the refinancing, what is the return on equity? Well, our current profit is $220,000. We get that profit margin of 11% times our 2 million of sales. So current profit is 220. And that would be our net income. Let's see if there's any changes to that. Probably won't be. And its return on equity before the refinancing is 17.6. And how do we get that? Well, return on equity is net income divided by equity. And equity is stated to be, well, we have, okay, here's an interesting point. All right, so if we have assets of 2.5, this is actually going to be a good throwback. We've got assets equals liabilities plus equity. Okay. Liabilities plus equity. You really can't get much worse in terms of drawing than I can, right? All right. Well, it looks like we had a debt ratio of 0.5. Interesting point there. Well, if we had a debt ratio of 0.5, that would mean that liabilities is half of assets. So 2.5 million. Now here's where you really got to follow it. This is some crazy stuff, isn't it? 2.5 million of assets. Debt ratio is debt and assets. So we're going to say this is 1.25. And so is our equity because they have to balance. So half and half, 1.25. Now, this is just saying, right, that our equity is half of 2.5 million, which is 1,250,000. So our ROE before the refinancing is 220 divided by 1,250,000. And then the return on equity after the refinancing, this is going to be equal to, well, 220 divided by 60% of that 2.5 million, because now your debt went to being 40% rather than debt was half. So you could just use that same part of the equation, right? Same percentage that seems equity is balancing out those assets. 60% of the 2.5 million is going to get us the denominator for equity, and we get a final answer of 14.7%. Isn't that great? Isn't that wonderful? I think it is. You'll get questions like this where you got to bring the accounting equation into play, and oh boy, better be ready for it. But you know it, you're going to knock it out of the park and do super well. Some more profitability ratios to memorize and keep in mind as we run through the exam. Well, we've got our growth rate, and this determines how significantly our company is growing. And we're going to take into account the return on assets, which we'll see in a second. Now, what is retention? Retention is essentially how much of your income are you getting to keep. You're spending all of your money. If you're paying it all out to shareholders or you're spending it all on expenses, that's not necessarily the best, right? We have the concept of retained earnings. You want to maintain at least some of your profitability in order to continue to grow in the future as a company. This is return on assets times retention divided by 1 minus the same. Next, we have return on sales. And as mentioned, all these return on, these are all going to be net income. So return on means net income. Return on is going to mean net income in the numerator. Now you see return on sales. This one is just a little different, right? This is just a good general rule. When in doubt, just net income. So here we have income before interest income, interest expense, and taxes. Right, so this just takes out taxes and anything to do with interest. So it's more operational. The return on sales, right? We're talking more about operations. ROI, return on investment. This is net income divided by average invested capital. So really net income divided by investment, net income divided by asset, net income divided by equity. It's just average invested capital, which is generally what you put up, right? Your assets that you invested. So similar here. We're gonna have a little bit similarities between these two. And just keep running through. Make sure you have these memorized and you'll do well. Let's run through an example. Well, we've got our profitability ratio example, right? Here is the growth rate that we saw. Let's do an example. Well, we have ABC company maintains a return on assets of 8.5% in year one, as well as ensuring a policy of paying out 35% of all earnings as dividends. What is ABC's expected growth rate? Now, this 35%, this is going to be our retention rate, right? This is income that we retained in the business, and now we're choosing to pay it out as dividends. This is after, right, we had all our expenses covered. Now we have some extra income, extra revenue money that we get to distribute to shareholders, and that's what we're going to do. So it's as simple as return on assets times retention, return on assets times retention. We got the 1 minus that on the bottom. Just plug and chug formula here. Nothing crazy, nothing out of control. So this is our expected growth rate, right? This is how much we expect to grow year over year as a company. Now, if this was 0 because we don't essentially retain any income, net income, then yeah, our growth rate's probably going to be 0 because we're not going to grow. And that is our growth rate. Next, we have another profitability ratio. Here, we're going to pull a bunch of formulas together and work through it. All right, so what is the return on assets? Well, Fireplace Company has an asset turnover ratio of 10 and a profit margin on sales of 0.04. Well, as I've mentioned, pull together all formulas that have to do with what's mentioned in the question. So first, you got return on assets. I would just write that out. See, right? Return on assets. Next, it mentions an asset turnover ratio. So as such, bring that to your notes. Profit margin, right? Bring your profit margin out. And then you start to see, well, okay, how do these fit into the bigger picture? Well, this is actually our asset turnover ratio. We remembered our DuPont ROE formula. We've got a profit margin right here and financial leverage that's over here, but no worries for that for now, right? So what is the percentage return on assets? Okay, well, to get return on assets, we need average assets and we need net income. Okay, well, we have sort of a conglomeration of those, right? So we have 0.04, which is the net profit margin, times the asset turnover ratio. And why do we just multiply these two together to get our answer? Well, because what we're doing in essence is this financial leverage, you could say it's 1. So cross this out. But we're really just taking these two components of the DuPont ROE, and because of cross multiplication, right? Anyone remember that from school? Uh, Gosh, it's crazy with the algebra that goes on. You can just cross out these two, right? You're technically multiplying them by each other. You multiply these two by each other, and you're right. You are going to get 0.04 times 10, and that gets you your return on assets. Now, again, this is cross multiplication. This is taking algebra into account. You gotta refresh yourself on some algebra, how this all works, and right, just we are using all these formulas coming together. So again, we might not use all the formulas that we write down, but it's a good habit to write down all formulas that you're kind of getting hinted at toward in the question. I would definitely recommend doing so over and over. We got some more profitability ratio examples, because what would I be if not the one guiding you through how to answer these? Well, Horatio Company began operations 111 and had the following financial information presented. So what is Horatio's ROI as of the end of year 2 since inception? So we've got 2 years of operations to calculate. Well, ROI is net income divided by average invested capital, and looks like we've got invested capital here, and it's average invested capital, right? As such, we're going to average these two together. And you see that step right here, right? We're going to average that, just a simple average, because they're equally weighted. We've got invested capital in year 1, invested capital in year 2. Add them both together, divide by 2. That gets you a denominator of 40. So that's our average invested capital. For our numerator of net income, you just need to find out what is the total net income for both. Well, sales minus expenses, you see it calculated here. We add them both together, and that gets us a total net income between both year 1 and year 2 of $150,000. 150 divided by 40 gets you an ROI of 3.75. Obviously, you want a higher ROI because you want to make more money with less invested. But that won't always be the case, right? We're not always going to have the best ROI, but that's the hope. That's the goal, right? In terms of understanding the ratio, we want a higher one. And now you got it. Now you got it. You got it. You're doing well. Keep staying strong and stay with me. We're powering through these questions.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.